Hey guys! Today, we are going to study about the revenue cycle. And for us to clearly understand this cycle, we will divide it into three general parts: the revenue cycle activities, the revenue cycle controls, and the physical systems. Let's check out this video about the overview of revenue cycle.
Welcome to the revenue cycle, sales to cash collection. What is the revenue cycle? It's a recurring set of business activities and related information processing operations associated with providing goods and services to a customer and the collection of cash in payment for those sales. If you're like me, you may need plain English to explain this. It's what it takes to get a customer the goods and services they want and collect payment from those customers. Let's look at the primary objective of the revenue cycle. It's to provide the right product in the right place at the right time for the right price. Now there are four basic revenue cycle activities: sales order entry, shipping, billing, and cash collections. Here's an easy way to remember these activities. If you want to make revenue, sail a ship with Billy cash. Sail a ship with Billy cash. Now I know what you're wondering. Just how much revenue does Billy Cash make? Well, we'll answer that later. First, let's look at an example of the revenue cycle in action. Let's say the law school orders J-Dogs for their graduation party. They will first need to fill out a sales order. They can do one on paper, or they can go to J-Dog's website and order there. J-Dogs has to approve the law school's credit before making the order. Once that's taken care of, J-Dogs prepares the order and ships it over to the law school. At the end of the week, J-Dogs sends a bill for the order. After they receive the bill, the law school sends the cash.
First, in the revenue cycle activities is the sales order procedure, and here are the steps that must be followed. Step 1. Receive order. Step 2. Check credit. Step 3. Pick goods. Step 4. Ship goods. Step 5. Bill customers. Step 6. Update inventory records. Step 7. Update accounts receivable. And Step 8. Post to general ledger. Now that we already understand the overview of revenue cycle, let's jump right into shipping process.
The process of shipping involves two main parts: picking and packing the order, and shipping the goods. Now these boxes are inputs and outputs to this process. For example, when you make a sale, the sales order entry process produces a sales order and a picking ticket. Wait, what's a picking ticket? Well, it identifies which products and quantity of each product to remove from inventory and ship. That's basic enough. It just means what you need to pick from the inventory. So the picking ticket is sent to the warehouse and the goods are picked and packed. The packed goods are sent to shipping, along with the picking ticket and the sales order. These documents are reconciled, and the shipping department creates two copies of the packing slip and bill of lading. Now, you probably know what a packing slip is, but you may not have heard of a bill of lading. It's a legal contract that defines responsibility of the goods in transit. The word lading means the action or process of loading a ship or other vessel with cargo. So when you hear lading, think loading. Thus, the bill of lading defines who's responsible after the loading has taken place. The goods are then given to the carrier along with the bill of lading and the packing slip. The copies of the bill of lading and packing slip are then sent to billing and accounts receivable.
Second is the sales returns procedure. Step 1. Prepare return slip. Step 2. Prepare credit memo. Step 3. Approve credit memo. Step 4. Update sales journal. Step 5. Update inventory and accounts receivable. And Step 6. Update general ledger. Here's the complete data flow diagram for sales returns procedure. As shown in the data flow diagram or the DFD of sales returns procedure, when the goods are returned by the customer, employees assigned in the receiving department will count how many goods are returned, inspect what are the possible defects of the goods, and prepares a return slip describing the item. There should be 2 return slips to be prepared, in which the first copy, along with the goods, will be sent to the warehouse to be restocked, then records the stock to be replaced. The second copy will be sent to sales function to prepare a credit memo, a document that gives authorization to the customer to receive the credits for the goods returned. When the credit memo is prepared, it will be sent to the credit manager for approval. However, if a clerk has an authority to approve, it can be sent directly to the billing function, where sales transactions is reversed and update the general ledger directly. Once the credit memo is approved, the manager will return the approved credit memo to the sales department and record this to the sales journal as a sales contra entry. After the update of sales journal, approved credit memo is then forwarded to the inventory control function, where the inventory will be updated. Once the inventory were adjusted, the approved credit memo is then to be accounted in accounts receivable, where the customer's account will also be adjusted, and the credit data will be posted to AR subsidiary ledger, while the AR summary will be posted to general ledger. Periodically, inventory control sends a journal voucher summarizing the total value of inventory returns and posts it to the general ledger, and the product quality replaced will be posted in inventory subsidiary ledger, and the approved journal voucher will be compiled in journal voucher file. And lastly, the third subtopic in revenue cycle activities is the cash receipts procedure, and the following are the steps that must be followed. Step 1. Open mail and prepare remittance advice. Step 2. Record and deposit checks. Step 3. Update accounts receivable. Step 4. Update the general ledger. And Step 5. Reconcile cash receipts deposits. Here is the complete data flow diagram for cash receipts procedure. To start this procedure, an employee in a mailroom will open the envelope and look for the payment of the customer and the remittance advice, which contains payment date, account number, amount paid, and check number of the customer. The mailroom employee will give this remittance advice to an administrative clerk who will reconcile the amount of each remittance advice together with their corresponding checks and record each check on remittance list or cash pro list. The clerk is going to prepare 3 copies, where the original copy will be sent with the checks to the record and deposit checks functions. The second copy with the remittance advice will be sent to AR records. And the third copy will be used to reconcile cash receipts and deposits. Then go back to the AR records. The payment amount received are used to post in AR subsidiary ledger, while the AR summary will be sent to general ledger function to be updated. The general ledger functions reconcile the journal voucher and the account summary and post the cash and AR control accounts to the general ledger records. The approved journal voucher will be compiled in a journal voucher file, and the clerk from a controller's office reconcile the cash receipts and deposits of unapproved journal voucher. A check, together with the remittance list, in the record and deposit checks functions will be verified by a cash receipt employee if they are accurate and complete. Then after reconciling, the employer records the check in the cash receipts journal. Check together the deposit slip prepared by the administrative clerk and will be forwarded to the bank for validation, then returned to the company, which is the customer, for reconciliation. At the end of the day, cash receipt summarizes the journal entries and sends the journal voucher to the general ledger function to be updated. After we learned about the revenue cycle activities, the second part is the revenue cycle controls. And here are the controls considerations for computer-based systems. First, transaction authorization.
To ensure proper purchases and payments are made, the following steps should be followed. A buyer orders products and provides a purchase number to the seller. This authorizes the seller to sell goods to the company. A copy of the purchase order goes to the accounting department. The purchase order should include the numbers of the items ordered and quoted prices. The seller then ships goods to the buyer and sends an invoice to the accounting department of the buying company. Once the items are received by a buyer, a receiving report is prepared detailing the items received and quantities. This report is also sent to the accounting department. Once the accounting department has received a copy of the purchase order, the invoice, and the receiving report, a comparison is made to make sure everything checks out. If it does, this invoice can be processed and authorized for payment. If not, the discrepancies need to be investigated. And that concludes this short video explaining internal controls over cash, receipts, and payments.
Second, the segregation of duties.
The key to good internal controls over cash receipts by mail is separation of duties. The person receiving the cash isn't the same person who is recording customer payments into an accounting system. You see that the cash goes to a separate department or person than the remittance advice. At the end of the period, we perform a bank reconciliation to make sure all of the amounts deposited in the bank are the same as what was recorded in the cash ledger. Some of you might not be familiar with the term remittance advice. Here is an example of one. Often it is attached to the bill or invoice, and you just separate it at its perforation and include it with your payment check. It contains all of your account information that the receiving company will need to post a payment to your account properly. Strong internal controls over payments is important to protect cash as well. Companies need good separation of duties between operations and writing checks for cash payments. Payment by check is an important internal control for the following reasons. The check provides a record of the payment. The check must be signed by authorized personnel. And before signing the check, invoices and other evidence supporting documentation must be reviewed.
Segregation of duties is an example of an internal control that a company would implement to reduce the amount of accounting mistakes, but more commonly to reduce the incidence of fraud. And so all segregation of duties is saying is this: no employee at the company should have two or more of the following duties. Okay, so let's go through these in turn. We've got custody of assets. So if we take cash, for example, cash is an asset, we're talking about physically handling the cash. How would that happen? Well, let's say the employee opens the mail. They might receive physical cash, they might receive a check from a customer, and so forth. So another duty is the authorization of transactions. That has to do with approval of certain transactions. For example, maybe it requires a manager's approval for a return of merchandise that has a value more than $500. Okay, so if we're talking about approval of customer returns, that would be an example of authorization of transaction duty. Recording of transactions has to do with the record-keeping aspect of who is actually making the journal entry, or if we're talking about cash again, who is the one that when we receive a check in the mail actually records in our accounting system that, okay, customer A has paid their bill. We just received $10,000 from them. And then the final duty is reconciling existing assets to recorded amounts. So periodically going and say, okay, let me count the assets and see if that matches what we have on the books. So we do not want any employee at the company to be able to do more than one of these at the same time. So for example, let me show you what could happen if you didn't have segregation of duties. Let's say that you have an employee named Susie. And Susie has both custody of assets and recording of transactions. She has two duties with respect to cash because Susie opens the mail and she receives checks from customers occasionally when she opens the mail for the company. And then she's also the one who records that, hey, I've received this check from the customer. So let's say customer A sends a check of $20,000 to the company. And Susie is the one who opens the mail, so she receives a check for $20,000. And let's say that Susie doesn't have the best ethics, so Susie takes the $20,000 for herself. She takes that check and she's able to get it cashed and she keeps the $20,000. Now, what is going to happen? So this $20,000 is not going to be applied to customer A's balance. So what is going to happen is eventually customer A is going to receive a notification that, hey, you still owe us $20,000. What is customer A going to do? They're going to call the company and say, hey, I sent the check. Here's the check number. And Susie's going to be in trouble. So Susie is going to be aware of this. And Susie is going to say, okay, well, in a little bit, maybe the very next week, we have where customer B sends a check. Customer B sends a check, and let's just say it's $20,000. It could be more than that. It could be, but to make it simple, let's just say it's $20,000 as well. So this customer sends a check for $20,000. So what Susie does is says, okay, well, I'm also the one who records in the transactions in the account. So I'm going to take this $20,000 I just got from customer B, and I'm going to apply it to customer A's account to show that customer A paid $20,000. So that customer A doesn't call up angry and say, hey, I already paid $20,000. So this $20,000 here went to Susie, but then the $20,000 of customer B, Susie applies that amount toward customer A's balance. So it looks like in the accounting record keeping system that customer A has paid the $20,000. So customer A is not going to call and complain. Now, in a few weeks, customer B, who just had their $20,000 applied to customer A, is going to say, hey, I paid this money, and so forth. So what's going to happen? Well, Susie is going to go to customer C. When customer C sends a check, Susie is going to apply that amount toward customer B, and so forth. So this is called lapping. So this is a fraud scheme where Susie's going to continually, she's going to steal money from the first customer, and so to basically steal the cash because she has custody of the asset. She's going to steal a check and deposit it for herself, and then she's going to manipulate the accounting records when this customer, so that this customer doesn't say, hey, I paid my bill. She's going to take the new checks that she gets from future customers and apply it to the previous customer, and she has to keep doing this. That's why it's called a lapping scheme. Now, if we have segregation of duties where Susie she opens the mail and receives the cash and checks, but somebody else is in charge of the record keeping. Somebody else is the one who actually goes and records that, okay, this customer A, they paid their $20,000 and so forth. If these duties have been separated, then Susie will not be able to perpetuate this scheme. Okay, then basically what she would have to do is to carry out the scheme, she would have to find the person who is in charge of recording the transactions. So if Susie opens the mail and there's someone else recording the transactions, then Susie would have to find that person and they would have to collude. Okay, so you can get around segregation of duties when you have multiple people participating in the fraud through collusion. But segregation of duties makes it much harder for any one person to commit fraud.
Third is the supervision. Fourth is the accounts records. Fifth, access controls. And sixth, independent verification. Now, let's talk about the last general topic, the physical systems. And this was composed of the manual system and computer-based system. Computer-based accounting systems. So, what is the difference between automation and reengineering? Automation involves using technology to improve the efficiency and effectiveness of a task. This simply replicates the traditional manual process that it replaces. Reengineering involves radically rethinking the business process and the workflow. In addition, automation and reengineering techniques are applied to both sales order processing and cash receipt systems. 3 fields of sales order. Number 1. Sales order number. It is the primary key that uniquely identifies each record in the file. It is also the pre-printed number on physical source documents. Number 2 and 3. Account number and inventory number. Both are secondary key that is neither uniquely identify sales order records. Its purpose is to locate records in AR subsidiary and inventory master files. Automating sales order processing with batch technology versus re-engineering sales order processing with real-time technology. Let's first discuss the automating sales order processing with batch technology. These are the following sections included here: Sales Department, Credit Department Approval, Warehouse Procedures, and Shipping Department. The Sales Department records the essential details and prepares multiple copies of sales order, which are held for pending approvals. Credit Department Approval. If credit is approved, Sales Department releases copies of the sales order to the Billing Warehouse and Shipping Department. Customer order and credit approval are then placed in the open order file. Warehouse Procedures. Warehouse Clerk receives stock release copy of sales order and uses this to pick goods. While in the Shipping Department, Shipping Clerk reconciles products received from warehouse with shipping notice. If there is no discrepancies in the Shipping Department, Bill of Lading is prepared. Bill of Lading is a shipment receipt when the carrier delivers the goods at a predetermined destination. The shipping notice, which came from the Shipping Department, was sent to the Computer Department and convert it into digital form. Re-engineering sales order processing with real-time technology. Interactive system provides real-time input and output with batch updating of some master files. There are 2 procedures in the re-engineering sales order processing with real-time technology. The first one is the transaction processing procedures. This includes sales procedures, warehouse procedures, shipping procedures. Sales procedures. Number 1. System accesses the inventory subsidiary file and checks availability of the inventory. It then performs a credit check by retrieving the customer credit data in the customer's AR file. Number 2. If credit is approved, the system updates the customer's current balance to reflect sale and inventory by the quantities of items sold. Number 3. System automatically transmit a digital stock release documents to warehouse, digital shipping notice to shipping department, and record the sales in open sales order file. Sales order file structure includes close field that contains either the value of N or Y. N means record is created, while Y means closed records have been shipped, so customers can now be billed. Warehouse procedures. Clerk's terminal immediately produces a hard copy printout of the electronically transmitted stock release document. Shipping procedures. The clerk reconciles goods, document, and hard copy packing slip produced on terminal. Shipping notice contains date and freight charges. Number 2. General ledger update procedures. At the end of day, batch update program searches open sales order file for records to mark closed and update the general ledger accounts such as inventory control, sales, cost of goods sold, and AR control. Batch program prepares and mails customer bills and transfers the closed sale records to closed sales order file or sales journal. Advantages of re-engineering with real-time technology. It greatly shortens the cash cycle of the firm. It gives the firm competitive advantage in marketplace. It permits identification of many kinds of errors as they occur. and it reduces the amount of paper documents in the system. Automated cash receipts procedures versus re-engineering cash receipts procedures. Automated cash receipts procedures. Main points of the system: mailroom, cash receipts department, AR department, and data processing department. Mailroom. The clerk separates the checks and remittance advices and prepares a remittance list. Checks and lists are sent to cash receipts department, while the remittance advices and lists was sent to the AR department. In the cash receipts department, the clerk reconciles checks and remittance lists and prepares deposit slips. The clerk also prepares journal voucher of total cash receipt. In the AR department, the clerk receives and reconciles the remittance advices and list. Via terminal, the clerk creates the cash receipts transaction file based on individual remittance advices. At the data processing department, at the end of the day, batch program reconciles journal voucher with transaction file of cash receipts and updates AR subsidiary and general ledger control accounts. In the mailroom, the clerk places batches of unopened envelopes into a machine that automatically opens them and separates their content into remittance advices and checks. The system uses a special transaction validation software, the system that reads the handwriting, the system that scans remittance advices and checks, that verify the current amount on each, wherein the remittance advices and the checks should be equal, and the checks are signed. Point of sale system used extensively by retail organizations, wherein cash, checks, and bank credit card sales are valid. Point of sale system doesn't have an AR account, and the inventory is kept on store shelves. Customer personally pick the items and carry them to checkout location. Daily procedures of POS. Number 1. The checkout clerk scans the universal product code label on items. Number 2. When UPS are scanned, the system automatically calculates taxes, discounts, and the total amount of transactions. Number 3. The clerk enters the transaction into the POS system via register's keypad. The record of the sale is added to sales journal in real time. Sale is recorded on 2-part paper tape, wherein the receipt was given to the customers, while the internal tape was secured internally within the register. Number 4. At the end of the clerk's shift, the supervisor unlocks the register and retrieves the internal tape. Cash drawer is removed and placed with new cash drawer containing a known amount of start-up cash for the next clerk. And the supervisor and the clerk take the cash drawer to the cash room, or also known as the treasury. Number 5. When contents of cash drawer have been reconciled, cash receipts clerk prepares a cash reconciliation form. The first copy was sent to the sales clerk as a receipt for cash remitted. The second copy was recorded to the cash receipts journal. End of day procedures. Cash receipts clerk prepares 3-part deposit slip. Now, let's check out the video about electronic data interchange.
What is EDI and how can it benefit my organization? In simple terms, EDI, or Electronic Data Interchange, allows your company's computer systems to talk to your trading partners' systems and exchange business information electronically. EDI is routinely used by organizations for electronically exchanging business documents, such as purchase orders, invoices, and shipping information, and can be seamlessly integrated with leading ERP and accounting systems, enabling the process to be automated. Implementing EDI enables the business processes associated with the exchange of business information to be digitized and automated, thereby removing manual, paper-based processes and reducing expenses in areas including stationery, forms and paper, printers and ink, document storage, lost documents, and postage. One of the most notable advantages of using EDI to automate the exchange of documents from a supplier's perspective is that it can halve the number of man-hours in the order-to-invoice process, reducing lead times and speeding up payments. The efficiency and accuracy of order processing is also improved, allowing staff to focus on more value-added tasks. Being EDI compliant also makes your business more attractive to potential customers that insist on suppliers trading via EDI, providing you with a competitive advantage over those suppliers that are not EDI enabled. EDI also assists in improved forecasting and planning, as your company receives early notifications of likely orders, so you can adjust your product and stock levels accordingly, thereby increasing customer service levels.
Re-engineering using the internet connects to thousands of potential business partners with no formal agreement, risk for both seller and the buyer. Control considerations are both applied for computer-based system and PC-based system. Number 1, authorization. Number 2, segregation of duties. Number 3, supervision. Number 4, access control. And number 5, independent verification. PC-based accounting system. PC application tend to be general-purpose system. Why? Because it can serve a wide range of needs and to meet the specific user requirement. PC system in small firm. They use it to automate and replace manual system for them to become more efficient and competitive. PC system in large firm with decentralized operation. PC systems are modular in design to provide some degree of flexibility in tailoring system needs. Now, in this illustration, as you can see, the modular design technique represents a decentralized operation. The central control program or menu-driven control program provides users interface to the system that makes a menu selection to go in a module that the users needed. PC control issues. Number 1, segregation of duties. This is the inadequate segregation of duties. Number 2 is the access control. This is the inadequate control over access to data files because computer tends to be weak. And this is the end of our lesson. I hope you learned something from this. Bye!